Diving right back into the numbers this week, we were looking at China's trade balance as well as their inflation rates. Interesting, China has continued to widen their trade surplus, meaning that they're exporting more than they're importing. They didn't meet expectations, which is interesting to see. It still seems to be quite slow in terms of how their economy is progressing. However, some positive news to China on that was that their inflation rate ticked up as well to 0.5%. Inflation, they had been having deflation for the past couple of years. So we've kind of seen this push from Beijing to really get the economy going. And so a little bit of inflation kind of is a bit of a sign of that there's some renewed interest by the Chinese populace in terms of economic activity. So positive numbers on both ends, but still we see a slow moving China, similar to kind of what we're seeing around the world, where things might look good or look bad, but still slow moving in any direction.
I think in regards to China, it's interesting to see that the exports did not expand as much as they hoped for, so as the forecast was, but the imports, on the other hand, increased more than what the forecast showed. That also shows that maybe the global economy is not consuming as much anymore, and that the sentiment also within the people who are hired to purchase stuff, raw materials or products that are needed to work on to get to the end client, that there is less demand for that. And I think that is interesting and something that we have to follow quite closely. And it's also interesting to see the Chinese system, even though it is pretty much driven by the one party, it's still also quite segmented. So the different areas in China, they have a high level of independence in a way that how they run their system, which also led to quite a few of the problems they are currently in. So it will be interesting to see how that develops.
We had the interest rate decision of the US on the 31st of July, caused some strong ripples. Also, because the markets are trying to figure out how many rate cuts are going to happen. Beginning of the year, heading into the year, between 5 and 6 rate cuts. End of the first quarter, maybe 3. Into the second quarter, okay, there's only going to be 1. And now even people are saying, yeah, there might even be 3 now, because Jerome Powell came out and said, yeah, look, we're looking at to beat inflation. That's still our focus. However, there's some other concerns coming up as inflation comes closer to our target. And that kind of did some things in the markets, which were interesting to see. We saw a lot of trying to speculate what's happening in the markets reacting despite companies still showing pretty positive signs.
From my perspective, it wasn't that much of a trigger of what was following the interest rate decision. I think there were different or other aspects that were playing into it. So far this year, from the beginning till the interest rate decision on July 31st was more like bad news or good news, in a way that investors really wanted the Fed to lower interest rates. Now they said we're going to lower interest rates. Then negative news came out with the unemployment rate, which was higher than expected or anticipated, and also the jobs created, the non-farm payroll jobs created, were quite a bit lower than what was anticipated. On top of that lower number, about 70% of that was created by the government through directly or indirectly through the healthcare system or educational system and so on. And so there are these cracks we were talking about a lot in the past. And then on top of that, what also put some pressure on the markets was what happened in Japan. The Bank of Japan increased interest rates on July 31st as well, to 0.25%. And this led to a kind of a flash crash, in a way that so far interest rates were closed almost zero. And then now money costs something. And there is some aspect that is called a carry trade, where you borrow money from a country where money is almost free, and then you invest it into another country like the US dollar, where you get 5%. And as soon as it starts to cost you something, you're going to cover this trade, which can lead to a huge shift, which we also saw that the Japanese yen appreciated by about 10%
Yeah.
against the US dollar within 1-2 days.
Yeah, which is a crazy volatile move.
Yes.
Now, again, there it's always in play with currencies. There's a lot of these shifting, especially as you're talking about this carry trade, where you're borrowing money from Japan, investing in the U.S. to gain some advantage to a certain extent. Now, when you have those large transactions, a lot of the people doing that aren't your small time investor. You know, these are big institutions trying to figure out ways that they can earn money at the best possible way. And so I think that is a serious issue. I think, you know, in terms of the bond yield shifting, that's where that kind of shifts as we see this pull out, or, you know, institutions starting to advise investors, hey, maybe CDs aren't the right place to be right now, or they were the right place to be, and now it's time to start thinking about diversifying, getting out of CDs, and getting into some other investments like bonds or potentially stocks, you know, where you can earn a better yield because that yield's going to go away. And so you have, I think, a multiple reaction from these big corporations and institutions that cause a lot of the shift. Not all of it, of course. I mean, we saw with the market correction as private investors were selling, institutional investors were buying. So there is a lot of shifting at the markets that led to the volatility. And at the same time, you know, we do see on my side, when you look at the companies, it's not that their earnings are falling. It's just kind of the shift in things. And I think in terms of the Japanese yen, you know, that's an interesting currency that we've followed for a long time. And to see that it's appreciated so quickly causes me a little bit of concern, because we don't know what the counter reaction might be when it jumps so quickly.
I mean, yeah, it did appreciate very quickly, but before that it depreciated very quickly. I mean, within this year already it depreciated more than this 10%. So there was a lot of pressure on the Japanese yen, but now some of this pressure got released, and the expectations are also from our side that the Fed is going to lower interest rates within the rest of this year, and this will take away more pressure from the Japanese yen. So I could imagine that it will stay somewhere in this range towards the end of the year. There was also already a statement from the president of the Bank of Japan saying we are going to calm down. We don't want to create too much of chaos. Still, I do think that the decision was the right one to make, and investors just have to deal with it.
Yeah, absolutely. I think that's a very good point in terms of how you have to navigate the markets in the midst of volatility, which is always a challenge. And that's why we always believe in diversification here.
Definitely.
It reduces volatility massively.
But to me, it was also crazy to see that some investors came out after the market corrected a little bit. I mean, it's not even a proper correction for certain indices. I mean, for the Nasdaq it is since mid of June. But some investors came out asking or calling for an in-between interest rate cut from the Fed because the markets were dropping. And to me, it's crazy the reliance they have on the Fed. If anything doesn't look so well, that they are just reaching out and saying, oh, now you should lower interest rates, which I totally do not agree with.
No, and that's where you have to see the Fed, I guess, where we hope to see the Fed or a central bank remain strong and say, hey, we are supposed to be constant looking at price stability. With the Fed, they're looking at employment as their second mandate. And we're not going to bow to the whims of these investors or institutions who are scared that their investments might lose because they want free money to make money.
Right.
So I think that's a good point. I think we'll end it there. Next week we have U.S. inflation data that we're going to look at. That's something the Fed is certainly keeping their eyes on. Come September, we're not going to have an interest rate decision, most likely in August if the Fed stays strong. And then we'll look at Japan's GDP growth or gross domestic product.
Wonderful.